Well, number one, Shane, I think the big issue on everybody's mind economically, globally, right now is inflation. Economic indicators that drive inflation up have increased. Um, I'm not yet concerned about inflation unless it looks like it's starting to get out of control. Part of the impact of that inflation on the bond market, Fed rates have hiked over the last 18 months. That has driven up bond prices, and that's my business that I pay very close attention to. Um, and part of the fallout there is bonds that could be potentially refunded at lower rates, much like you refinance your home or would refinance a
Hmm.
car note when interest rates change. That party, at least for now, is mostly over. We've done a lot of that. In fact, refunding of bonds, existing bonds, has constituted about half of the market in Texas over the last couple of years. That's not going to be the case in 2024, and it wasn't the case
Hmm.
in 2023 either. My message to most people out there would be stay calm. Inflation is never good, especially when it ramps up quickly. But you think back to the pandemic and all the PPP money and all the other
Hmm.
financial aid that came out of the federal government, we quadrupled our M1 money supply. When you have basically the same number of goods and services out there in the market and you quadruple the money supply, price of things is going to go up. And
Right.
in fact, it took a long time for it to go up, but that was a very logical consequence of having all that money flow into the economy and quadrupling of the money supply. I actually expected inflation to be worse than it is. I expected some shortages at the grocery store and other places where we buy goods and services to be worse than it is. In fact, the one place where it's probably hit the hardest is in the construction market, where uh, wood, concrete, steel,
Hmm.
wiring, and electrical supplies are not always easy to get. You, as a governmental issuer, may have money that you want to spend on a project, and that project may be sitting empty with no workers working on it for a couple of weeks because you can't get the steel, the concrete, the wood,
Right.
the electrical parts and plumbing parts that you need to continue. So that I see has been a big impact on the bond market per se, uh, as a result of the inflation and the supply shortages. They may say we've got a little money in our debt service fund. Instead of refunding some of these bonds that are now callable, and maybe saving a little, let's just pay them off. Pay them
Hmm.
off now. Be done. Let's save a lot. I'm
Hmm.
seeing more of that. I saw more of that in 2023. I'm seeing more and hearing more discussion about that sort of thing here in early 24. I've got a couple of clients who are looking at that as an option. And I think that's going to be the new refunding party. And that may change. If rates go down 25, 50 basis points, suddenly there's some debt that will look refundable that wasn't a viable refunding 6 months ago. Um, we may seesaw back and forth between paying off some debt, refinancing. I don't think we're going to get back to the point where refinancing is 50% of the market like it was a couple of years
Gotcha.
ago.